I'm Tom Stelzer and welcome to Livewire's Alternative Series for 2025. Today I'm joined by Rachel Lockyer from MLC to discuss the MLC Global Private Equity Fund and the opportunities in private equity for investors right now. Rachel, thanks for joining us.
Hi Tom, great to be here today. How are you?
Good, thanks. Can we just start if you just give us a quick overview of MLC and the Global Private Equity Fund?
MLC is one of the largest superannuation funds in Australia, and we have been investing in private equity for over 30 years. So MLC Super's private equity program is managed by the MLC private equity team. We have grown to manage investments on behalf of other superannuation funds, global institutions, wholesale investors and retail investors who are interested in MLC's private equity program because we have access into, in high demand, private equity managers globally who historically have demonstrated top quartile performance. The program has been global since day one, and we are invested in the mid-market. So we're looking at businesses that are, in the range of 200 million enterprise value all the way up to $1 billion, where we see significant alpha to be able to be generated, because fundamentally you're buying businesses that have significant growth opportunities ahead of them in the hands of great private equity managers and aligned incentives and management teams.
And you guys invest across the private equity spectrum, but what would you say is the edge that you're bringing to your strategy at MLC?
Yeah, we are a high conviction manager, so we spend a lot of time finding what we feel are the best in class private equity managers globally. We have offices in New York and Sydney. We have people on the ground who are really working to find amongst the thousands of private equity funds in the market who are the ones that are the most hungry, the most aligned with us, and will deliver returns that are top quartile. And we've consistently shown that through 3 decades of investing in private equity, that we're able to find the managers that, when you're investing in them, you may not know of them, they may not be a household name, these private equity funds, but by the time they're doing their, first or second or third fund, they're delivering first quartile returns. And so that is, I guess, the what we feel is the alpha in the private equity asset class. We're not investing in 300 managers across the globe. We're investing in a high conviction approach, mid-market managers who are specialists often in their sectors and who have demonstrated a very long and solid track record at prior firms, and we back them having known them for many years. And as I mentioned, we get to co-invest alongside them and generate superior returns in that way.
How would you say the portfolio is positioned at the moment, and what do you think that's telling us about markets?
Yeah, I would say ripe for exits, Tom. We have an average age of 5.5 years for our investments, vintage year diversified. They're all generating strong EBITDA performance, and many of them are ready for exit. So typically a private equity investment's held for 5 to 7 years, sometimes longer, sometimes shorter. The exit market is absolutely heating up right now. So it has been a relatively slow start to 2025, but right now, we've had quite a few exits in the last month. One demonstrable one would be, With Intelligence, data analytics and insights provider for private markets and hedge funds, which we invested in about 2 years ago through a specialist financial software manager called Motive. We invested in that business at an enterprise value of about $500 million US. Last week we sold it for $1.8 billion. That business was sold to S&P Global, and I think it shows that strategic buyers and corporate buyers are out there and they're hunting for private equity investments. And the differential between private market valuations and public market valuations is quite substantial at the moment. In fact, there's about a 44% difference between public market valuations and private market valuations, with public markets obviously being a lot higher. So well-capitalised corporates are looking for these PE assets to grow their businesses and happy to be a beneficiary of that. In the mid-market in which we're playing, there are multiple avenues for exit. So typically, the businesses that we're buying are a valuation range of between sort of 200 mil EV enterprise value to $1 billion enterprise value. So when you go to sell those businesses after 5 to 7 years, sometimes 2, there's a large exit pool. So you could sell to corporates, you could sell to other private equity funds, or you could sell to the IPO market, which increasingly is being used. If you look at the exit environment right now, about 50% of the exits are going to corporates, which is more than there have been, historically.
And if we maybe just take a look slightly further back, I think 2024 was a big vintage for the funds. Do you have an example of an investment you made from that year, and maybe you can talk us through that?
Yeah, we made a lot of investments in 2024, and one more towards the end of the year was a company that does printing for large corporates. And while that might sound quite basic, it's a US-based business, so it does all the wrappers across the Amazon trucks, the fleet that goes around the country delivering, goods to lots of people in the US. Those trucks are updated weekly with new wrappers, from an advertising perspective. But it also services a huge range of large corporates and retail storefronts, retail and point of sale. Interestingly, the customer base has been around for an average of 16 years, so it's got embedded customers that are providing recurring revenue because these point of sale retail graphics are updated very regularly for promotions. The investment that we did was alongside one of our top performing US managers who very quickly noticed during due diligence that the large amount of customers, 55% of those customers were actually only delivering 1% of the revenue, which were a very unprofitable sort of customer base. But they had a huge amount of sales team dedicated to, the smaller end of the market. So once we invested, and that was in December 2024, the private equity manager very quickly, stopped servicing those smaller customers, which were unprofitable for that business, and restructured the sales team to really be focused on medium to large customers. And already that's resulted in a significant drop of profit to the bottom line. And the business is ahead of forecast.
And maybe moving on to the opportunities right now, I think you touched on your global allocations before, but what regions and sectors are you seeing the most potential in?
Yeah, we're sector and region agnostic. We go where the deals are. We are well positioned for opportunities in markets in which they come, and that's why geographic diversification we feel is critically important. I mean, we saw earlier on this year, after the tariffs were initially announced in April, deal activity in the US was a bit softer, and a lot of capital went into Europe. We have been quite active in the European region as well as the Australian region, and it's interesting across a lot of the deals that we've done this year. There are many are in the healthcare, equipment and consumables industry. We really like healthcare, but we prefer healthcare that's less people reliant and not so much a deployment of staff into hospitals or aged care homes per se, but looking at consumables such as the sterilised vials that are used in hospital settings. So we invested in one of the largest providers of commercial grade sealants and vials for the UK. So it was a carve out of the NHS. If you need morphine in a hospital in the UK, you're using one of these vials, the doctors are. It's a very regulated industry, but was fundamentally, not growing as fast as it could be under the NHS ownership. So that was one of the investments we did in Europe. We've also invested in mobility aids for older people who are needing wheelchairs and other aids. One of the largest providers here in Australia, and in the US we've looked at moulding companies and other sort of healthcare related businesses. And so if you're doing injectables for Ozempic and the rest, and increasingly the auto injectors are being used for cancer treatment, asthma, a lot of other treatments are now using them because it takes people away from being in the hospital and they can actually inject themselves. So this is a growing area, and we've invested in one of the largest sterilised spring providers that goes into those.
I think you mentioned one example there, but what's your presence like in the Australian private equity market?
Yeah, pretty strong. We have been fundamentally supporting the Australian private equity market for 30 years. We're one of the first investors into many of the PE funds here. Right now we've got 6 core managers here in Australia that we're working with really regularly on opportunities. We're obviously benchmarking them against the US and Europe, and we're working with very high performing managers here.
Maybe we turn to the risks that are around private equity at the moment. What would you say they are, and how do you guys go about mitigating against them?
Yeah, so it goes back to what I was saying about the secondary market, Tom. So the secondary market has had a huge amount of capital coming into it more recently. Fundraising records have been set in the secondaries private equity market. That has meant that there's a huge desire for secondary funds to deploy capital. And historically, secondary private equity investments have really relied on a discount that you get when you buy a secondary of private equity. It's usually from a forced seller. And so the discounts have ranged from sort of 25% to 10%, but now they're very low. So that discount has really reduced because of so much capital going into the market and now really requiring secondaries to deploy. Additionally, you've got the evergreen funds. Many of them have a requirement to deploy capital and are going to the secondaries market to do that, and they typically pay over more traditional secondary buyer would to get access to those secondary opportunities. When we look at the returns for the private equity industry, we still believe that the primary investments in private equity will outperform the secondaries investments over time. We've seen that, as you'll see in the slide. We've seen over time in the broader market, primaries do outperform. And we like primaries because, as I mentioned, we see a lot of value creation occurring early on in the private equity investment's life. And we think it's important to be there for that first institutional capital and the amazing amount of growth that you can get when you heavily align incentives in the management team to the private equity outcome and the strong returns that we expect. It's typically in the first sort of 3 years.
And just moving to your funds, why do you think investors should be considering the MLC Global Private Equity Fund right now?
Look, the MLC Global Private Equity Fund has a very nice diversified set of investments across managers, geographies and sectors, and it's really well positioned for exits, as I mentioned, with an average age of about 5.5 years. What differentiates us is our access into the primary funds of these managers that are highly aligned with us to demonstrate strong results and deliver those results. And also, we are working with the best managers globally. It is the private equity alpha, not the beta, so to speak. And we are really excited about the opportunities ahead. We continue to see some very attractive opportunities in the private equity market.
And finally, where can investors find out more about the funds?
They can go to the MLC Asset Management website or speak to their business development manager, who'll be very happy to help explore private equity for them.
Rachel, thanks for joining us.
Thank you, Tom.
Thanks for tuning in. For more from our alternative series, make sure to check out the Livewire website and YouTube channel.